to take a slight, right turn, you might say, from uh,
Uh-huh.
all of the other news. We're going to just focus on tax updates, particularly for folks who have retired early and drawn money out of their 401ks and IRAs.
Okay.
So I'll be giving some tax tips that people need to be aware of, plus things that they might do to cut down their tax bill if their kids attend day camps and summer camps, since we're in the middle of summer.
Sounds interesting. I was just like to mimic a friend of mine. I'm down with you like four flat tires.
Yeah.
All right, my friend. Have a good show.
Yeah, thank you so much, Mr. Brown. Welcome, listening audience. This is Everett James, your trusty tax reporter, who comes on every Wednesday morning at 10 a.m. That is 10 a.m. Pacific Coast time. That would be 1 o'clock, I believe, East Coast time. This show is dedicated to listeners and tax filers, whatever your status. The show invites your participation. Please, if you have questions or if you have comments, please let that be known to Mr. Brown and myself. That way, we can put together some responses that we promise will be broadcast in the following week's program. And for those who make a earnest endeavor to communicate with us, we will offer a free tax consultation and possibly a tax preparation service for those who extend themselves and submit questions or comments, either by phone or by email. For those who prefer just to phone in their comments and questions, tax questions, the phone number is 951-522-9877. To repeat, 951-522-9877. And for those who prefer to use the electronic mail, our location is um, evjtax1 at gmail.com. That's evjtax1 at gmail.com. Okay, here we are, folks. 60 days post 2023 tax filing date, which was per normal April 15th of 2024 for the tax year 2023. Most folks observed that deadline, keeping in mind that the deadline was not only just for filing your tax return, but it was also for paying the taxes due. That always seems to be the taxes due part is sometimes conveniently left off the must-do list of many tax payers. For those who have discovered that in this day and age of sky-high inflation, there just wasn't sufficient funds to make a payment to IRS for the taxes due. At least make a partial payment uh, in in our vernacular, at least extend the olive branch to IRS with making a partial payment with some kind of indication or statement or promise to pay the remaining amount ASAP. The To begin with, the news media, oh, it's just been full of Hunter Biden's plights. we all heard, about his conviction on falsifying information, on an application to purchase a firearm. And wow, he was found guilty on all three major felony charges. Um, and in addition to that, he is also liable or found liable earlier for tax fraud. The and he is has been indicted. He was actually indicted last December, pleaded not guilty rather to all counts. Prosecutors allege that Hunter Biden engaged in a 4-year scheme to not pay, and that I emphasize not pay at least $1.4 million in income taxes for taxes covering years 2016 to 2019 for about 3 years. They claim that at least the IRS claims that he actually made more than $7 million with an M dollars between during those years. Well, that's quite a bit of money. He's charged with 6 misdemeanor counts of failure to file his tax returns and pay taxes. He's also charged with 1 felony count of tax evasion, not avoidance, and 2 felony counts of filing a false return. So the tax evasion is the big time charge that he's going to be looking at in the California case. The case is set for September 5th, or actually it was originally to begin June 20th, but the judge agreed to push it back to September 5th. In any case, those charges have to be dealt with, and this reporter would like to keep you up to date on tax fraud cases that do come into public attention, simply for the reason that, as you can see, not following through with your tax obligations, and then taking an active step to make it appear as though that the charges have no basis. Taking those kinds of steps is fraught with the risk of becoming the subject of special scrutiny and possible felony charges. So we move on to the topic of the IRS is ramping up its enforcement efforts. That's really a lot of it is due, to just the spending windfall that the government engaged in 2022. In 2022, federal lawmakers did promise IRS $80 billion to be spread out over 10 years. That was in addition to their regular annual funding. Over half of that actual money was for increased enforcement and collection measures. This year, Congress did claw back about 25% of the funding. Last year, IRS released its operating plan discussing what it would do with the extra money. And on enforcement, IRS said it would do considerably more audits of big C corporations and partnerships. Individuals with high income, over $400,000 a year, special attention across border activities, digital currency, and more. You know, some of the latest statistics have shown that digital currency activities and profits that are not reported. IRS does report that their studies have shown that there's like about a 75% um, non-compliance rate for reporting those profits, and IRS is coming after persons who do not report honestly. The large corporations would see their audit rates skyrocket under IRS's plan. The audit rate, to show you just what's been happening generally, the audit rate for uh, in 2019 for just C corporations, that's the form used 1124, was 0.4%. 0.4%, 4 tenths of a percent rate. But now they are IRS is planning to reach a audit rate of around 9% for large corporations, and you can see that in the job job notices and requests, where they are reaching out for persons who have experience with filing taxes for large corporations, in addition to representing clients who have been notified of audits, who are representatives of the large corporations. The IRS states that they want to raise the figure, 9% figure, that it has attained over time until it reaches 22% of returns. That's quite that's really, wow. You might even say that's a real attack on corporate America. You should also expect that C corporations with less than $250 million in assets, that's also going to go up. So not only will they those C corporations reporting more than 250 million in assets, they're going to be auditing the C corporations with less than 250 million. That's quite a that is quite an objective. The For large partnerships and S corporations, and I might mention that many people in our listening audience probably, if they're not a large partnership, they may, qualify as an S corporation. But even the coverage of your type of corporate entity, that's going to increase dramatically. Right now, it's only at about 1% of all of the S corporations that are getting audited. But 1%, might seem small, but just keep in mind that for several years, the audit rate for partnerships and S corporations have hovered around at 1/10 of 1%. So from 1/10 of 1%, it's going to be kicked up to increased up to 1%. Wow. So that's going to be quite a bit for all of those folks in our listening audience who file forms 1065 and 1120-S, 1120-S, standing for the S corporate tax returns. Okay, wealthy individuals with lots of income would also feel the heat from the audit activity. The overall audit rate for 2019 individual returns was 0.3%. But individuals reporting $1 million or more of income had a higher audit rate of 11% for 2019 returns. So I'll keep you try to keep you up to date in those areas. They're going to be continuing their annual funding. Receiving annual funding from IRS to do audits of other individuals as it has in the past. So knowing what auditors look for in selecting returns for exams in crucial, and there has been, considerable public knowledge made available for the public to be aware of what the red flags are for audits. And I will go over that. We may not get to that today, but there is a published list of 19 audit red flags, and we'll, as I say, if we don't get to that in this morning's program, we will do that on a repetitive basis over the next few months. IRS is still pledging not to raise audit rates for taxpayers earning less than $400,000. But specifically, the agency vows that individuals and small businesses with earnings of $400,000 or less will not see more audits when compared with historic rates. And it's our understanding that this applies only to taxpayers with total positive incomes up to $400,000, meaning income before taking losses and deductions on the return. To repeat that again, that's what that means is positive income up to $400,000, and that's before you reduce the income by taking deductions and losses on your tax return. They will be pursuing that objective to fulfill the current administration's desire for greatly expanded revenues. For several reasons, and I would say probably the biggest reason recently is the huge influx of migrants from all over the world without any vetting whatsoever, and that has been the numbers have been estimated at 10 million plus. Quite an additional financial burden that the taxpayers have had to shoulder. Okay, one question that I might pose to the listening audience: are you married? What if you're married and only one of you works and earns compensation? Well, as far as retirement savings, you can make a spousal IRA contribution for your spouse or for the spouse who is not working. For 2024, if you file a joint tax return, you and your spouse can each contribute up to $7,000 to an IRA plus a $1,000 catch-up contribution for people who are 50 and up. So that'd be if you are over 50, you can make that IRA contribution up to $8,000. It doesn't matter if one spouse has zero earned income, just provided the other spouse has taxable compensation. And keep in mind that the total of your combined contributions to your IRAs cannot exceed the taxable compensation shown on your 2024 return. So you can make that contribution to an IRA, but it cannot be more than what you actually earned. Anyone, can contribute to the traditional IRA, no matter how high your taxable income. There are limits, however, income limits on the Roth IRA contributions, and you can find that out by going online, or certainly staying in touch with your tax preparation organization. You can qualify to make a full Roth IRA contribution for 2024 if your adjusted gross income is less than $230,000. Just keep in mind that for folks who have income over that, it does start to phase out for adjusted gross incomes between $230,000 and $240,000. It appears that because of the ongoing inflation that we are living through, more and more 401k and IRA investment advisors will be required to act as fiduciaries when giving investment advice to clients. So you have, and I'm sure you've heard of seminars and workshops being held by financial advisors, many of them who have had a strong interest in that area of business advice, set up their own businesses, and are giving really very, very impersonal workshops, very, very user-friendly workshops on the contributions that can be made to your 401ks, various IRAs, the traditional IRA and the Roth IRA, which you can and cannot do with those investment devices. Okay, I may have, since we're on 401ks and other workplace plans, you can borrow more from 401ks. You can up to the lesser of you can borrow, but there's a ceiling that you cannot exceed, and you can borrow up to the lesser of $100,000 or the $100,000 or 100% of the account balance. The repayment terms can be extended by up to 1 year if the plan otherwise allows for this disaster relief. And by the way, because of inflation and other economic hardships, IRS has been allowing folks to avoid having to pay that 10% penalty if one takes money out from their 401k or their IRA before age 59 and a half, and what we call that that age qualification. But you do have to meet the emergency or is it the emergency hardship rules? And the emergency hardship rules do require that the taxpayer actually have a legitimate emergency financial situation, and the emergency has to meet standards of not being preventable, not being something that could have been forecast in advance. It has to be truly an emergency. And you can, the Secure 2.0 law just recently passed that allows you to avoid that 10% penalty for taking money out before age 59 and a half. If you did have to take it out to meet such a financial emergency, and it allows you to take out allows you to take out without penalty, without that 10% penalty, up to $1,000, just but one annual distribution during the year. For folks who have been accustomed to deducting all of their homeowner and condo association fees, and they've been over the years up to 2017, they've been accustomed to deducting those fees on the Schedule A. Of course, because of the 2017 tax law, those type of fees have not been, actually it's been the situation since before 2017, but a lot of folks have been deducting those condo fees just along with all of the other miscellaneous itemized deductions. But since the 2017 law, there's been a sharp restriction preventing them from deducting those expenses. Now, for those who have and been deducting those expenses nonetheless, and not having heard from IRS, there are two exceptions that would make this entirely deductible and put your mind at ease. First exception is the fees that landlords pay on residential rental property are tax deductible, and you can claim those in Schedule E. The second exception is if you're self-employed and you use part of the home for business, that can include the homeowner and condo association fees that they pay on Form 8829, line 22, and that's the fee that you can deduct when calculating your home office deduction. Keep in mind that for self-employed individuals who do use that Form 8829 form for calculating your home office deductions, if some of the listeners would like a closer look at employing that 8829 form, please call in, to myself or via email and request a closer look, and we'll make it the subject of one of a whole hour of this program. Something else that does come up is if you receive damages or settlement proceeds, if you've had a physical injury or a physical illness. Keep in mind that the money that you receive for physical injuries or physical illnesses, keep in mind that they're generally not taxable. Again, the money that you receive for physical injuries or physical illness are generally non-taxable. However, there's always a however in tax accounting. Compensation for emotional distress is, on the other hand, generally taxable. So if it's for physical injuries, not taxable. If it is for emotional distress, that's generally taxable. And there are two very, very narrow exceptions. One is if the amount that you got paid, if that mental anguish, if that arises from physical injuries, tax free. And the same applies to reimbursements for medical treatment of emotional trauma. But outside of those two very, very narrow exceptions, it's going to be taxable. The the IRS knows that some taxpayers mistakenly report taxable damages as tax-free. Well, if there's an audit, agent will review the court petition or they'll complain or claim that was filed and with that showed the original ground for the lawsuit. They'll check over the settlement agreement to see how the document actually characterizes the amount paid and received by the party. Now, here's an example. A family brought a civil suit against state workers for violating their constitutional rights after the family was falsely accused of neglect in the death of their daughter and their other children were placed in foster care. The family's underlying complaint did not request relief for physical injuries or illness or for emotional distress. That was a big case. They had a $25 million settlement that was reached. The family treated the proceeds as non-taxable, claiming that they suffered from PTSD. Wow. I can just, when PTSD came into vogue as being the grounds for benefits, strictly from folks who suffered from those combat related illnesses. Well, that was used quite a bit. And now they've really expanded that PTSD characterization to all kinds of situations. But IRS, on the audit, they took the approach that the money the family received was fully taxable. And they went to court on it. Unfortunately for the family, the tax court agreed because neither the settlement papers nor the complaint referenced sickness or PTSD suffered by the plaintiffs. Wow. If you get a settlement such as that, and if it's taxable, keep in mind you're generally taxed on the gross award. A lot of folks might think, well, you take the total award and then deduct the money for the lawyer and then only pay the balance. Nope. Without if you are taxed on that gross award, you're taxed on it without reducing the amount for attorney fees. So say a lawyer who represents you, in which you award $100,000, you receive the money, and then of course the lawyer deducts 30 grand in attorney fees, and then sends you a check for $70,000. Well, unfortunately, the full $100,000 is taxable to you. Now, in the past, some of the non-business related legal expenses were deductible on Schedule A as miscellaneous itemized deductions. and that was subject to 2% of the AGI threshold. Meaning that you couldn't deduct it unless the actual fees were above 2% of your AGI. But along comes the Trump era 2017 tax reform law, and that canceled this class of write-offs through 2025. So individuals generally cannot deduct these legal expenses on Schedule A. If the underlying case was business related, however, then the taxpayers can deduct the lawyer's fees on Schedule C. So the big difference, though, is if you're in business and there's a business connection with those damages, you may be able to deduct that on Schedule C. But if not business, oh, sorry. Okay, there's been many changes. One of the biggest, I guess, financial news just recently, has to do with the Medicare subject, and whether or not, many persons have forecasts that we're going to just go bust in 2032. Wow, 8 years from now. Oh, wow. That we're going to go bust as far as being able to pay for the Medicare Part A coverage, for our treatment. Well, and that's the Hospital Insurance Trust Fund. That's what's used to pay for Medicare Part A benefits. Well, it's called the hospital HITF. That stands for Hospital Insurance Trust Fund, Hospital Insurance Trust Fund. But anyway, they've been forecasting that that's going to be broke as of 2032. Wow, 8 years from now. But now, according to the current projections from trustees, that the Hospital Insurance Trust Fund will not be able to pay fully scheduled benefits at least until 2036, 5 years longer than for what has been forecasted in the past months. So it's until 2036. So that's at least a little bit longer before the forecasts about running out of money by 2032 that's been, or 2031, that's been extended now. And the reason that they are predicting that will be good for 5 years longer, and the reason is that there's an increased number of covered workers who will pay the taxes, and the average wages of the workers is forecast to be higher. So despite the good news, however, experts are always looking to shore up the Hospital Insurance Trust Fund. There are a lot of ideas to raise revenues. Not surprisingly, of course, it's not unusual that they involve tax hikes. President Biden wants to hit upper income individuals with more taxes, as you've heard. He would increase the current 0.9 Medicare surtax imposed on employees and self-employees, employed persons, with over $400,000 of earned income. So they are current government is looking to, if you are in that um, a category of income over $400,000, your taxes have a greater than a huge likelihood of being increased. the There are some ideas out there by some think tanks, and that's, for example, having workers pay the Medicare tax on employer-paid health insurance. Oh, that will, I'm sure, set up a huge outcry by the folks who are um, working for a corporation and where they're having their health insurance paid for, uh, and not having to deal with that. See, right now, of course, the employer is paying the tab on those health premiums, and those health premiums are excluded from your taxable wages, as you will notice. If you look at your W-2, you'll see that you are not being charged tax-wise for the premiums, for the health insurance premiums. One option is to subject all or part of that employer-paid insurance premium to the 1.45% and 0.9% Medicare taxes paid by employees. So a limited approach would impose those Medicare taxes only on the employer-paid insurance of high earners. So it would just, if the change was made, if you were in the lower income category, you would not be hit with this. But if you're in the higher income category, you would be required to pay for those insurance premiums that previously or heretofore had been paid by your employer. So the lawmakers have lots of time to flesh out this revenue and cost saving options. Let's hope they don't wait until the last minute, to act on possible changes. It's probably time to just consider what are some of the health alternatives for the coming year, for 2025. One option is the health savings account. Now, granted, the health savings accounts have been around for quite a few years. The health savings account really do have some important benefits. One is their tax advantaged arrangements. They are used to manage your health insurance deductibles and out-of-pocket costs. And also, on the other hand, lets you save up for your future healthcare expenses. What are the advantages? Well, the contributions to health savings accounts are deductible from your pre-tax wages. For 2025, this coming year, the limit on deductible or pre-tax health savings account pay-ins is $4,300 for just yourself, and $8,500, $8,550 for family coverage. Folks who are 55 or older, it can put in an additional $1,000 into their health savings accounts. Keep in mind that the earnings inside the health savings account, they can build up value and is tax-free for the account owner. Health savings accounts do not have that use it or lose it rule like flexible spending accounts that do have that use it or lose it, but health savings accounts do not have that rule. And any withdrawals that are used to pay medical expenses are not taxed. Now, those are the upside for the health savings accounts. There are some downsides. According to a recent report by the Consumer Finance Protection Bureau, the major trustees that offer health savings accounts charge lots of fees, and there are costs to account owners and employers. Money that is parked in the accounts do earn a very low interest rate. Now, of course, account owners can invest in higher earning funds, but most don't. Only 7% of health savings accounts have funds in investments. And employers who are pushing why do they push the health savings account option to employees? Well, that's because of the cheaper premiums. So it's now just a reminder for folks who have missed the past April 15th federal tax deadline. It has come and gone, as you know, but we're about 60 days past that April 15th deadline for filing and paying 2023 tax assessments. If you live abroad, and this is just to let you know, since we are on the sunny side of this deadline, if you do live outside the country, you have until June 17th, to pay the return. And I'm have to, let you know that we are just on the, on the cusp of that June 17th, which is this next Monday. Wow. That's incredible. But there is that June 17th deadline. Something for employees regarding your business expenses. At one time, you could deduct your unreimbursed business expenses on the Schedule A. But as you know, the 2017 Trump tax law suspended all of those unreimbursed business expenses through 2025. So, and I did go over all of those, the changes that will be taking place at the end of next year. One of them, of course, was the unreimbursed business expenses that have been available to be deducted on the Schedule A. They were previously deductible, subject to the 2% of the adjusted gross income limit, but because of the 2017 tax law, they all got those deductions got suspended. Keep in mind that there is an exception if you're a disabled worker. They can still itemize and take the costs of impairment-related aids that enable them to function more easily at work. So if you're disabled, you can still deduct those expenses, even though the non-disabled cannot, since the 2017 tax law. Now there are some employees, other type of employees, can write off some of those unreimbursed costs elsewhere on your return, and then just keep in mind, think Schedule 1. Teachers, if you're a teacher, you can deduct up to $300 of the costs on Schedule 1, line 11 of the 1040. Other persons who can deduct those unreimbursed business costs, other people beside teachers, folks who are considered statutory employees, folks who are agents or commission delivery drivers, people who work in the home. sellers of life insurance, and some traveling salespeople who use Schedule C. So keep in mind those self-employed individuals who do things that involve delivery of items, people who work in a home, um, folks who are considered to be agents, such as life insurance agents, those types of individuals. That also includes performing artists with at least two employers. If you are in that category, if you can write off those unreimbursed business expenses. If you have had at least two employers and you earned $200 or more in wages. And another limitation here is that your costs were over 10% of your income, and your AGI was less than $16,000 or less. That would apply to performing artists. There also is a break for reservists or National Guard members on overnight trips of over 100 miles. You can also deduct just some of those unreimbursed business expenses. So it's one of the ideas that has come forth for the tax advantage savings accounts. And this is an idea that's been proposed by Senator Bob Casey, a Democrat from Pennsylvania. And he proposed that children have tax advantage savings accounts. And his bill that he has put forth, it would have a pay-in total of $2,500 per year. States could also contribute with no limitation. The federal government would toss in an extra $500 per year for kids in households with adjusted gross incomes of $75,000 or less, and that's if you're single, or $150,000 or less for folks who are married. The distributions would be tax-free if used for education, opening up a business, for job training, or buying a home. Rollovers to Roth IRAs or ABLE accounts would also be permitted. So that's sounds like a very, very good idea that is being proposed, which would help folks in the lower middle income groups, and particularly help families do something to secure the future for the children. Now we are in the middle of summer, and I like to repeat some of these things because it still applies. The summer camp costs for your children, they qualify due for the dependent care credit. That is on Form 2441, and this credit is available for camps, for sports, for math, instruction, for theater, for robotics, or just general fun. Now, the thing that unfortunately does not make those costs deductible is the cost of summer school or tutoring programs or overnight camps. Those types of camps are not eligible. But if they're just daytime camps for sports, math, theater, robotics, or just having fun, they are eligible. But keep in mind, there are rules for claiming this child dependent care credit. And the general rules are the child has to be under the age of 13, and the expenses have to be incurred so the parents can actually work or look for work. Again, a child must be under age 13, and the expenses have to be incurred so the parents can look for either look for work or they can work. The Now here's a tip for college graduates who start a full-time job this summer or fall. You can use part year withholding to increase the amount of money in your paycheck and have less tax withheld. The standard federal tax withholding tables just they're written. They just assume you're going to be earning a full year's income when figuring out how much income tax to take out. The part year method, however, is for people who are employed 245 days or fewer in a year. And it sets the withholding according to what you earn during the part of the year that you're actually on the job. And if you can ask your employer in writing for this, but this is very, very important for our college graduates who are starting a full-time job this summer and need the money, the most they can get in their paycheck, and they need that check without it being decimated by taxes. This applies to high schoolers or college students with a summer job. This is just a little bit of tax advice. You can escape and totally escape that federal income tax withholding from your paychecks if you owed no federal tax for 2023, all of last year, and don't expect any federal tax for any of the current year, 2024. So again, you can avoid any federal income tax withholding on your paycheck if you owe no income tax for last year for 2023 and don't expect any for this current year, 2024. All you have to do is write exempt below step 4 on your W-4 and just fill out steps 1A, 1B, and step 5. For the just general knowledge, they have a free IRS has a free file program that will continue through at least 2029. This program, lets lower and middle income taxpayers use free commercial tax software to prepare and e-file returns. It certainly has occurred to this broadcaster that there's certain categories of people who are not crazy about this free file program, and guess who? Those who prepare taxes, and the industry, whole huge industry of tax preparation companies, and of course they see that as direct competition for their businesses. So that pilot program, has been a success. There's been a lot of favorable reviews from folks who used it. Under the pilot, 141,000 taxpayers have filed returns under this pilot project. IRS intentionally kept it narrow, and as far as those who are eligible. But starting in 2025, this next year, more taxpayers will be eligible to benefit from this direct file program. They do want to expand the program to folks with more complex tax situations. because there are a lot of restrictions on who can use the program, even restrictions on the number of states that can use this pilot project. So, as I mentioned, tax software firms such as TurboTax and H&R Blacks and a large number of other tax firms won't be happy about this free direct file program. They definitely see it as a competition. They'll be out there, I can guarantee you, lobbying hard against this against this program. The we're coming close to the end of our weekly program, but I do want you to know that that the tax programs and the tax structure is really changing dramatically. Has been radically changed since 2017, and the tax-paying public really does need to be educated on a good number of the changes, because even this tax reporter has a number of clients who are still operating in their mind under the old tax rules, and that is very, very harmful, and it doesn't help in helping them keeping the proper books and keeping the proper receipts, because they actually are planning to, in their mind, to use those deductions, and the receipts and documentation that they're keeping, unfortunately, is not covering the areas that are still deductible. Most of the receipts and documentation just cover those things that have now been removed as legitimate deductions. They've actually have been eliminated as deductions on Schedule A. So this reporter will make every effort to keep you up to date on the deductibility of many items, and keep in mind that the main change since 2017 has been those unreimbursed business expenses above 2% of the taxpayers' AGI. So the changes continue, and there's a lot of, unfortunately, a lot of the good ideas for improving the taxpayer structure for taxpayers have really not been publicized, or have not hit the news because of all of the other acrimony and struggle between the two political parties, particularly with this huge election coming up November 5th of this year. And can you imagine? That's only July, August, October, 5 months or so off. But we will attempt to keep you up to date, and keep in mind that for those who do want to pose a question, a tax question, or a comment, please take advantage of the opportunity. We can be reached at phone number 951-522-9877, or by email by sending in your comments and questions to evjtax1 at gmail.com. That's evjtax1 at gmail.com. And then, of course, the offer remains good for bestowing a complimentary tax consultation and or preparation of preparation guidance for your tax return, either the last year or maybe one of the last few years. The the number of changes that one has to deal with is continuing to grow. I might add that much of the material that is presented comes from Kiplinger, the tax letter that has been in existence for many years, and it's the tax letter comes out on a weekly basis. It's publicized online as well as mailed out through the snail mail process. But as time goes on, of course, that form of communication through the mail is used less and less. And I would say currently at the current time, availability of its information and guidance have pretty much been restricted to online publications as opposed to actual mail sources. So the we have we are now in the period of time